Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
So we're going to talk a little bit about the lower middle market, PE interest in that segment of the market, and kind of your assessment for where you think the market is right now and outlook for 2026.
Fantastic.
But first, you want to tell us a little bit about Align and the space that you guys operate in?
Sure. So we at Align are a lower middle market investment bank serving founder and family-owned businesses who are in search of their first liquidity event, traditionally in the 2 to 20 of EBITDA space. So a lot of good old family-founded businesses.
And private equity demand in the lower middle market space, especially over, if you look at the past 5 years, the past 10 years particularly, has really ramped up into becoming one of the primary drivers in the PE market. Could you talk us through a little bit of what it is that's drawing a lot of PE firms down market and why?
Sure. I think there's three kind of key things converging over the past 10 years and the last 5 in particular. First, you have, I think, what's been dubbed the silver tsunami, if you will. You have a boomer population, if you will, of business owners. I think the statistic is they own roughly 67% of all smaller businesses. And they're starting to get to an age where they're not sure how much more road there is to run. They're also the first generation to have put all of their children through higher education. So, the days of owning mom or dad's pest control business are no longer. Their children have gone on to be doctors and engineers and pursued their own passions outside of the family business. So time is creating a transition necessity. But at the same time, you see private equity investing in, as our last speaker put it so well, a buy and build strategy. You can cover more ocean when you can buy 20 smaller businesses versus one billion-dollar business. There's just a larger return on that invested capital. So, and there's also, from an organic growth perspective, it's easier with smaller businesses because they need the basic things like marketing and technology and professionalizing and making the business more sophisticated. So by virtue of that, you've seen PE pull down market and enact these buy and build strategies across a different thesis. So the supply and the demand are kind of marrying up.
As you see PE start to move downstream, are there particular sectors that are attracting more interest than others?
Sure. It's funny. I say that during the pandemic, the air quote essential businesses that were often referred to, the reason they're essential is because you always have to have them. So we see a lot of service-based businesses, both business and consumer, the things you have to have when we were all told to go home one day, and then the very next day, all of those people still had to go to work. So you're looking at a lot of your trade businesses, healthcare services, things people still have to consume. So you're seeing a very services-driven demand out of private equity. And then also, I think, both through the pandemic and obviously into today's macro environment, onshore supply chain, logistics, transportation is of demand. So we're seeing quite a bit of interest in contract manufacturing, food and beverage distribution. Again, the things you have to have, but we want to have them on our shore and have access to them so they're not finding ourselves piling up containers at the borders because either it's too expensive or there aren't enough product.
And with that said, with so much capital chasing a limited number of let's say, A assets,
yeah.
how would you describe the current quality gap that you're seeing in the market?
Yeah, I really liked how the prior speaker classified that. And as a banker, I don't take offense to whether it's A or B in their mind, because not everything is a fit. And that's actually, being on the sell side, one of the things we preach to our clients is deals are available, cash is available, money is available. So let's make sure it's the right transaction for you. If you're part of that silver tsunami and you're looking to be on a beach somewhere in a year, well, we're not going to partner you with someone that wants you to roll and stay on for 7 years. That's just not a cultural fit. That's not a long-term growth plan fit for the buyer either. So you're not going to get maximum value out of that. It's not going to be a win-win. So we spend a lot of time working with clients, getting, frankly, just kind of into their psychology a bit around what does success look like. And then let's go and look for those partners versus just kind of taking what's available. Because they're getting lots of phone calls. Many of my friends and peers in the room here have gotten very creative in terms of the phone calls, LinkedIn messages, emails, event invites, trips, you name it, building that rapport as they were just discussing in the last panel. And that's good, but when an unsophisticated business owner, especially in our kind of demographic of business, they don't fully grasp and understand what the opportunity is that's being presented to them. And so by virtue of that, they'll look at them individually, and it may or may not be the right fit, and the business may or may not be prepared. So to your point, the quality there, because the owner hasn't really prepared for an exit, there's usually not management succession. The financials are usually messy. There's usually some clauses, like assignment clauses and things in agreements that haven't been addressed. Things that tend to be kind of key challenges. I wouldn't say deal breakers per se, but are hard to underwrite for a lender or for an investor. And so that's where we're seeing the real quality shift. I would say the macroeconomics of the last couple of years have started to hit balance sheets and income statements of our clients. So it's challenging some of the quality, hence the earlier commentary around maybe over-reliance on add-backs. And listen, in my line of business and with my clientele, there's an emotional attachment to their business. It's their baby. They've been running it for however many years. And so there's a unrealistic expectation of value sometimes. And so if you can show them the fundamentals and what the drivers are of value in the marketplace, you can help them understand what quality is and what it means and why there may be a B versus an A.
Has that shift driven any changes in the standard that sellers are looking for, or even the threshold that buyers have?
For sure. It's definitely helped to bridge some of that valuation gap that we've been seeing. 2021 was just such a white-hot year, and I think someone earlier referred to it as country club chatter. That's real. You hear about your peer or your friend who sold their XYZ business for some made-up number, because we all know that it's not the right one, but it creates a perception, and perception does become reality to some people sometimes, and so that's where that education and those strategic conversations with sellers of businesses is really important, because they have to understand how the market values businesses and then how their business lines up with those value drivers. If you can present that data to them, it makes it a bit more objective, so then a lot of that country club chatter and noise that they're hearing, it's a bit more objective. And as I mentioned, they're starting to see some of the tapering hit their financial statements, and that has brought things down a bit. So they're a bit more realistic to know, like, well, listen, the grass isn't always greener. It's not always going to be up and to the right. And so, maybe I need to sacrifice something today in order to make sure I can get what I want tomorrow.
You mentioned 2021, and we're seeing valuations kind of start to normalize after hitting that peak a couple years ago. Where are you still seeing valuation pressure today? Are there particular sectors that are also more insulated to that compression?
Yeah, I would say there's demand, right? I think the quantity of investors and acquirers, both strategic and financial sponsors, it's like a 3-to-1 ratio to the quantity of quality businesses. So that sheer imbalance of supply and demand is always going to keep valuations healthy. I just think they're not going to be that 2021 white hot where deals are closing in 60 days at these multiples that make us all scratch our head on how they're going to get that return on cash. And so it's normalized a bit to things that are still outsized. They're still very healthy because of that supply-demand imbalance, but at the same time can be underwritten, I think, more easily by the debt that is usually used to transact these businesses. And so certain industries that we're seeing service-based businesses, as I mentioned before, I would imagine everyone in those one-on-one meetings is talking about some version of home services, roofing, waste management, HVAC, plumbing, electrical, pools, landscape, you name it. That continues to be a sector in demand due to its high fragmentation. We're seeing quite a bit in healthcare services, maybe a little less in the physician practice management space as there once was back in 20 and 21, even 2019. That's tapered off a bit, but we're seeing some of like non-emergent transportation, specialty services, and obviously there's quite a bit of M&A going on in your R&D sectors like bio, pharmaceuticals, things of that nature. And then business services. There's a lot going on in technology right now. I think cybersecurity continues to be a really right place for consolidation, especially as those services need to move down market. Smaller businesses can't afford the Palo Altos of the world, but there are other IT service providers who can help create the infrastructure that they need, especially in the face of AI today. So I think those are the ones we're seeing insulated. The ones we're seeing affected, obviously are the ones that have supply chain and tariff risk, and mainly because it's just the pace with which the changes happen. We all could wake up today and there's some new decision, and then we could go to sleep and wake up tomorrow and there'd be something completely different. And as an entrepreneur and a business owner myself, that's hard to just pivot and deal with so quickly. Usually those things take longer, and you have time to strategically affect how you're going to manage that pricing change. So I would say those sectors, we're seeing it a lot in retail, manufacturing, and distribution, especially if there's a high reliance of foreign sourcing, and also service providers who source their raw materials for their services. They're feeling that pinch as the middleman. Like, can they get that pricing markup with their customers to offset some of those costs? Some can, some can't. We work with a really great exteriors business out in the western half of the United States, and their margins have gone down pretty meaningfully this year because they just weren't able to. They renegotiate their pricing with their customers every year, but then when their pricing changes overnight and that gets filtered through, they're the ones kind of in the middle getting pinched. So those are the ones that we're seeing some effect too. But what we're seeing, though, even in those sectors, is folks figuring out this new normal. I say normal in a very rhetorical way, but in a just learning to make those pivots in navigation. So we're still seeing demand for those businesses, and just knowing that they're going to have to weather the short term, I think, to get to the long term.
When it comes to sectors like the home services industry, a lot of other lower middle market founder-led companies, transaction readiness tends to be a key part of whether the deal gets across the finish line. Dealing with a lot of founder-led companies, what percentage of companies do you see that struggle with being transaction ready, and what are some of the gaps you usually have to help them close?
All of them. I would say every single client and mandate we take on in a given year, and we usually do roughly 40 transactions a year, every single one of them has that proverbial hair that was mentioned, because founders and entrepreneurs are just so focused in their business and are opportunistic, but by virtue of being opportunistic, aren't necessarily prepared. So we always like to say, I want to meet a business when they're thinking about exiting, so that we can work with them to get transaction ready. So I love coming to events like this and meeting with service providers who do sell-side quality of earnings, insurance risk analysis. legal risk analysis. As I mentioned, a lot of our clients get very surprised by their own contracts because they don't realize the language that's in some of them, that you have to ask permission for someone else to go through a liquidity event. And so that holds up a deal, and it can be a challenge, especially when you're trying to keep it quiet. So those little types of things, but they all add up. And so if you can get all of that good diligence done up front, it makes you all the more valuable, and that's what we preach. But I would say almost all of them, none of them are air quote transaction ready. It's just by virtue of their size and scale.
And when we think about outlook for 2026, what are some of the, zooming out for a minute, looking at the macro economy, what are some of the drivers that you think could impact deal making as we think about 2026, and what's your outlook for lower middle market deal flow?
Yeah, I think I read a great quote yesterday that said 2025 was the year of the rebound, but 2026 is going to be the year of the bull, which I love to hear. And I think that's right. We're even seeing it in our deal flow. We already have half of next year under contract in terms of mandates that we're going to be bringing out to market come January. That wasn't the case last year. So I think you're seeing the sellers in particular feeling more comfortable about what's going on in the macroeconomics. I think obviously lowering interest rates makes debt less expensive, opens that up so there's even more capital now to be able to put to work. And that's particularly meaningful for clients like mine who it also, in tandem with the cost, the underwriting standards are eased a bit. I wouldn't say it's 2021, but it certainly, the underwriting is a little bit more expanded, so it makes some businesses who've had some challenges over the past few months still very valuable and marketable and underwritable. So we're seeing quite a bit of volume, and I think sellers are back at the table to meet the demand from the buyers.
Are there particular sectors that you think may be more sensitive to the current economic cycle?
Yeah, I mean, again, I think manufacturing, logistics, logistics in particular, if you, here's a good case study. We worked with a business in Michigan who does logistics and moving for the auto industry. And that was just from one week to the next, ever changing in terms of tariffs. And so the OEMs were pulling back and pushing forward, and they just couldn't project how many loads they were going to have to run and what was going to happen. And so that was really challenging for them. So I think there are going to be some of those industries who are still affected by that you're going to have to look to. I think also healthcare is going to continue to see some challenges. I read a statistic just this morning that healthcare deals was the lowest it has been on record because of all of the instability and all the noise around Medicare and Medicaid subsidies, the cost of insurance. The reimbursement rates continue to go down, and that has an effect on margins. And so if reimbursement rates are going down, it's going to be hard to do that margin expansion and preserve quality of care, and that's the big balance. So I'd say those are the two that are probably going to see the most headwind going into 26. But again, I think there's just so much demand, and debt being less expensive, folks are going to be ready to write checks.
All right. Well, I think we'll leave it there.
Great. Fantastic.
Thank you, Dena.
Thank you,
everybody.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.